All you need to know is earnings, earnings,
Yep.
earnings. First of the year, the expectation was first quarter earnings going to be up 14%. Double that, almost 30%. So since the first of the year, S&P's up 10%. Earnings are up. Earnings estimates are up 15%. Right. So PEs are down 5%. Stock market's cheaper today on earnings than it was the first of the year. Wow. Earnings are trumping everything, and the list of everything just seems to grow.
Okay, at Lehigh University a long time ago, they didn't teach any of this real malarkey, modern inflation adjusted. The whole world was nominal. If we have nominal GDP, which is popping this market, and the nominal GDP changes to a lesser real GDP and a greater inflation, does that change the equity world?
Has to, because that would mean that there are cost pressures and there's less revenue growth in units. And that combination is not great. So far, that's not the problem, but it's probably coming before too long, Tom.
Bob, we had some better breadth in the market starting the year. And I'm looking at your notes that kind of summarizes it nicely for a lot of folks. Just 60 trading days ago, 60% of the stocks in the S&P 500 were above their 50-day moving average. Today, that's well under 50%. So do we need to start worrying again about the tightness of this market and the big tech stocks?
Certainly has to be something to be watched. Most markets that end at whatever high level, breadth has deteriorated before the downturn starts. Now, I'm not suggesting there's a downturn. Our friends at Strategas just put it out. We've just had 8 weeks up 18% for the S&P 500. That's the ninth best since 1950. The other 8 instances, 3 and 6 months later, the stock market was always up. And 6-month average rate of return, 11%. So don't get too bearish too soon.
Got rates higher, though. I mean, rates have been moving higher. I mean, Tom and I, we'd never quote the 30-year, but now it's above 5%. That kind of gets our attention here.
Totally agree with you. And when you look at the equity risk premium, you have to say, oh, my goodness, what's going on here? And the answer is, I hate to be repetitive, earnings, earnings, earnings. Right. Yep. As long as they're okay and the Fed is not hostile, stocks will be okay.
So, Bob, I go back to the Revenue Act of 1918. It was just before you and me. It was coming out of World War I. And we were trying to figure out modern accounting. LIFO, FIFO. Nobody in the room knows what that is except you or me. How do you LIFO, FIFO the new American economy, the service sector, the AI economy? I don't get how we're going to account for this modern age.
You're absolutely right, and that's why it's a whole lot more confusing. I mean, the manufacturing part that was LIFO, FIFO is about this big compared to what it used to be, and now we've got all these other things, all kinds of services, technology. How do you measure that?
Remember, Paul, like 2000, you know the week.
Sure.
2000 or something, we decided we had profit.
Yes.
And then like 90 days later, it was like, oops. I mean, I'm worried about that.
I think a lot of people are. And Bob, how are you thinking about just stocks, bonds, alternatives here? I mean, the stocks are just ripping. I mean, Tom's almost talking about getting out of the triple all leverage cash thing here. Yeah. So what are you doing?
So I'm fully invested. I think we're in a high risk bull market. The bull market means you got to be invested, and the reasons are twofold. One, the Fed is not antagonistic yet.
Okay.
And earnings are off the charts. Yep. When those two things happen, stocks always go up. Now, I can give you a long list of why it's a high-risk bull market, and that will come into play at some point in time, and then it won't be pretty.
But that's a classic Victoria Fernandez wall of worry. I mean, Bob doesn't have a wall of worry, but Victoria has one. Bob, I look at this market, and I look at the numbness of people. Like, everybody's trying to be a doobie and do their 401k right and all that. Are we too smart for our own good? Are we too diversified and fancy versus just believing whatever every listener believes in and just keep doing it?
Yeah, look, I think a lot of people think they're very diversified when probably they're not. I mean, when they come and take the girls out of the house, they clean the whole house out. And at that point in time, it won't feel like I'm diversified.
So how do you diversify against hard assets, commodities?
Yeah, you have some of that in your portfolio. You have some other alternatives, absolute return portfolios, equity market neutral. Yeah, you have a few bonds in your portfolio. That's not been a whole lot of fun. But as we pointed out with the equity risk premium where it is, having a few bonds makes some sense.
So it's interesting here. I mean, I think a lot of investors are trying to say, this inflation is real out there. I see it at the pump every time I fill up here, and companies are calling it out. But as you mentioned, earnings have been there. I mean, do we have a latent inflation concern out there?
It's an earnings, and the Fed being friendly to the market, which means not raising rates. You know they're going to move from this dovish bias to at least neutral, if not to a tightening bias. And then the threat, if inflation stays trailing 12, 3.8%, they'll eventually have to raise rates. Let's hope they don't have to do it anytime soon.